Stablecoins aren't just digital dollars anymore. The next big fight in crypto is about new wave of stablecoins that don't just sit in your wallet, they actually pay you yield. And two projects, Ethena and Aegis, are going head to head to define that future.
Right now, you can just take your USDC, USDT, whatever, put it into some yield-bearing stablecoin like Aegis or any other, for example, Ethena, and you can start earning yields that you can claim every week.
That's Ermin, the founder of Aegis. He spent a decade in trading and strategy, working with Cointelegraph, Gate.io, and as an investor in early stage tech. Now he's building Aegis, a Bitcoin-backed stablecoin with built-in yield and real-time transparency. But yield always comes with risks. And this is where the real debate starts, because Aegis believes Ethena has a major flaw in its design.
They use primarily USDT margin perpetual contracts, which means that, so if tomorrow USDT depegs, that could be the same with Ethena's stablecoin USD.
So the bigger question is, do people keep traditional stablecoins like USDC and USDT, or do they move into this new generation of yield-bearing stablecoins?
The yield-bearing stablecoins will become, let's say, a benchmark for crypto yield, a risk-free crypto yield, the same as you have in treasuries and TradFi.
So is Ethena unstoppable, or has Aegis found a weak point that could change the stablecoin market forever? This is the stablecoin battle you need to watch. So, Ermin, let's start with just the overall landscape of stablecoins. What gets you the most excited about stablecoins?
I think we live in a very exciting times in terms of like financial technology, especially in crypto and in the stable coin market particularly. I think we have never seen that range of yield opportunities connected to a stable asset. So before, if you look at the history of, for example, like financial markets and so on, there have been different derivatives, derivative instruments that you could use to generate some yield schemes or yield generation products, yield generating products. But with stable coins, it's basically the new level of it. What I'm particularly excited about is that right now you can just take your like USDC, USDT, or whatever, put it into some yield-bearing stablecoin like Aegis or any other, for example, Ethena, and you can start earning yield that you can claim every week. So you basically see the results every week of your capital basically working somewhere. That's, I think, the most exciting part. If we are not talking about just yield generation, I think stablecoins present a new wave of, tokenization of different assets. So basically through stablecoin, you can essentially tokenize everything. So before, like at the early stages of crypto, we tried to tokenize with just some crypto asset that still was a very volatile thing, and you basically didn't have lots of utility with it. With stablecoin, it's a different game. So you tokenize something, for example, real estate, you wrap it up as a stable coin, then you can use the stable coin to generate yield or to put it in some money markets across crypto, or lend it and use it as a collateral. And yeah, it just presents you with much more opportunities to utilize your capital and basically have some more yield and bring better capital efficiency to your portfolio. So yeah, I think I'm super bullish on the stablecoin landscape, and that's why I think we are also bullish within Aegis.
Now, I know that at one point there was a lot of conversation around flat coins, primarily because of the inflation problem and how typically stablecoins are not able to keep up with inflation, because usually stablecoins are pegged to the US dollar, whether it's the US dollar currency or other currencies. All fiat essentially is decreasing in value. So I'm curious to hear your thoughts about the concept of flat coin. Do you think it has the opportunity to disrupt the stablecoin market?
Yeah, definitely. But the main point here is, so for example, most of the stable coins, like the majority of the stable coins, they don't have built-in yield in them. So if you look, for example, USDT, USDC, they don't have native yield embedded into it. And the reason for it, because they were the first movers in the market. They are the oldest stable coins. They are the biggest ones, and they are pushed by most of the exchanges, wallets as the main asset that you basically enter into crypto with. So you use USDT and USDC as a window between like fiat world and crypto world. So that's why they are the biggest and the most used. But this new generation of the stable coins is essentially the yield bearing ones. And obviously it's harder to get traction on those because domination of USDT and USDC will still be there. And I think still they will be the biggest, but eventually, when the time comes, I think most of the users will start to switch to those yield-bearing alternatives, because having native yield embedded into one product, it's something that everybody wants to have. It's essentially like having your, you know, for example, if you imagine you using your bank account, right, and you have a bank app, and you first deposit funds into your account, and then you need to log them in order to start receiving some yield on your deposit, and it's basically multiple actions. With stablecoin, just one click, you bought it, and you start accruing yield on top of it. So yeah, it's I think.
What I'm hearing you say is there's a new evolution of stable coins that is coming, and that it won't necessarily evolve into a flat coin per se, but it'll just be stable coins that are yield bearing.
Yes.
So, well, yield bearing can be a little bit risky, right? Because what's actually happening behind the scenes? How are people accumulating this yield? So let's talk a little bit about that. So, 10 to 30%. I mean, how sustainable is it to generate these kinds of yields?
Yeah, I agree with you. Yield generation comes with certain risks that first the investor in the stablecoin or the buyer of the stablecoin bears as well. Uh, but I think, for example, what we do at Aegis, we try to be super transparent and show everything what we do with the collateral of the users. So there are definitely like many mechanics on how you can generate yield in crypto and bring deliver the yield bearing stablecoin. But I think that the most important thing is how the company or a stablecoin issuer presents the strategy and in what details they explain it to the end user. So, for example, on our side, we do basis trade. So we buy Bitcoin on the spot and we short perpetual futures on BTC futures. So essentially, what we do basis trade. We earn funding rate, we distribute it to the holders of the stablecoin. Let's say we create a derivative position that generates yield, and we distribute this yield to the users. It's a bit complex financial product, obviously, but if you think about it, it doesn't bear lots of risk. On top of it, especially if you consider that we are using only custodians to hold the collateral, we never move it to the exchanges. We regularly pass audits, so we have attestations from the custodian every month. We also have ZK proofs on the collateral that we have the collateral live in the custodian, and it's updated every 15 minutes. So we kind of like try to protect our users, and that's our first priority. We kind of like not focusing on bringing the highest yield in the market. We focused on the security and the protection of the collateral of our users. But some projects obviously that show like 20, 30% APR, doing some, on-chain lending, on putting it into money markets, like buying PT tokens on Pendle and so on. Obviously, that's a super risky strategies, because first you take risk of third party, so you rely on some other platforms that issue this, for example, PT tokens, Pendle. You also rely on lending markets like Morpho, so you believe that Morpho won't be hacked, and so on. So there are multiple risks involved in those strategies. But yeah, because the risk is higher, you can generate higher yield. That's the financial theory works here as well. But yeah, I wouldn't put my money into those strategies. And yeah, but it depends on the user, because in crypto in general, most of the retail users are risk takers. So that's why we see a lot of growth in this high yield stable coins that do some kind of, like, let's say, shady stuff.
Yeah,
Apart
and
from
I work in cybersecurity by day, so for me personally, I understand how important it is for users to, look at a smart contract report, for instance. But for these types of yield-bearing stable coins, like what would you say are the three main things that people need to look out for before, uh, actually using those stable coins?
Yeah, the first thing that I would look at is basically the underlying strategy, right? Whether it's like lending, RWA, so they buy treasuries, for example, on-chain treasuries, or they do basis trade. So first you need to look at the strategy and decide whether you are comfortable with it, because every strategy has its risks, underlying risks, and not every strategy is simple to manage. The second thing that I would look at is basically the team experience, because the team is super important for managing those strategies, because not everybody could be a good basis trader. Not everybody could understand how to allocate and rebalance positions in treasuries, for example. Not everybody understands how to do lending efficiently and how to control the margins and everything in terms of portfolio management, lending portfolio management. So that would be the second thing I would look at. And most of the projects that you see right now don't have sufficient experience to manage this. So it's very hard to predict what will happen when, for example, the bear market starts or something, like a black swan event happens in the market. And the third thing that I would look at is basically the audits, the security, whether they have everything in place, attestations from custodians or whatever they use. For example, if they use self-custody, basically some proof of the collateral that it is live and it is in the place that they use to store this collateral. So yeah, I would check everything on the security side. But most important things is basically strategy and the team, and security is on the third place. But yeah, those things are crucial. Without these things, I would not even consider investing in something.
So let's talk about the team. What's so special about your team, and what are some of the things that you are doing in order to prevent, users from getting wrecked if there is a black swan event, for instance?
Yeah. So our team consists of the professional traders with the 15 plus years of experience. So we're incubated and we're backed by Riverside Hedge, which is a prominent market maker. They started in TradFi in 2008. So basically in the turbulent times, but they scaled super good in the TradFi markets and then moved into crypto in 2017. So already have a significant experience in crypto as well, doing huge volumes on Saxes and DEXs. And they basically helped us to build the trading team on our side, and also to build risk team on our side, and helped with the trading technology. So first of all, we have the bulletproof technology in terms of trading. So everything on the execution side and architecture is super secure. And I kind of like believe that it's one of the best performing trading technologies in the market that currently exists. And the second one is basically the risk team and trading team. And I would highlight that risk and trading team, they're kind of like of equal importance. So if you have like a good trading team, but you don't have risk team, that wouldn't mean that you will be successful, right? Because the risk team is super important for this as well. Because risk team controls that everything is kind of like in line with the risk parameters, and that we are not overstepping in terms of our exposure to something, and that the collateral is safe, and that the internal mechanics works securely, right? For example, access to different accounts, and also access to the collateral is also super important, because that's the main question that most of the institutional liquidity providers ask, is how you manage, permissions to the collateral. So basically, who can do what with the collateral. So that's why we at Aegis we use basically, I don't think that you have a better solution than multisigs, but composition of multisigs is also important, because the way you distribute the keys to which holders, to which parties is also important. And we kind of like put a lot of thought into this before launching Aegis. So that was our kind of the priority number one.
Yeah, to your point, phishing attacks and private key mismanagement, those two combined have been outpacing smart contract vulnerabilities in Q2 2025. So to your point, it's really important to make sure that as an organization, you have that part down packed. Now, I wanted to ask you about Ethena, because Ethena is probably the most dominant yield-bearing stablecoin in the market right now. Would you say that you're offering something different from Ethena?
Yeah. So we really like Athena internally. I'd say that's one of the best projects that I personally have seen in the past, like 2 to 3 years in crypto. But we as a team, so we look at them, and we see that they still bear this one big risk in their architecture, and basically the mechanics of their underlying strategy, that we are not comfortable with. So I would personally, if Athena did everything perfectly, I would personally just put money into Athena and forget about building your own stablecoin and so on. But they still bear this risk of the third party stablecoin. So when they open the positions and when they hedge it, they use primarily USDT margin perpetual contracts, which means that their quote asset is USDT. You can think of it as a peg to USDT. So if tomorrow USDT depegs, that could be the same with Athena's stablecoin USD. So that's the main problem. I'm not talking about, USDT failure and that the USDT will go down, but even a small depeg can affect the collateral and the position that Athena holds, because Athena is essentially doing the same as we do, but they use USDT margin perps. So they buy Bitcoin on the spot and hedge it with, they short USDT margin perpetuals. In that way, you're kind of like exposed to the USDT price volatility. So if USDT depegs on short side, you will be in the loss if USDT depegs, because BTC USDT pair will shoot up in price. In our case, we don't use USDT margin perps, we use BTC margin. So in our case, everything is pegged to, let's say, BTC. So our unrealized PNL is in BTC, margin is in BTC. So we are kind of like protected from that. The only risk that we have is that, BTC drops 90% in a couple of minutes, or rises up 90% in a couple of minutes, which I think in the current market, obviously it was possible a couple of years ago, but I think in the current market with the current liquidity, the risk of it is super small, close to zero. So, yeah.
And so a lot of people are talking about how we might be going into a bear market beginning of the year. Are you guys prepared for, that, or it might be a curveball? You never know.
Yeah, I think if you look historically at, so we are earning primarily from funding rates, right? And the only risk that we have is that funding rates go into negative territory, and we start losing, margin, and we will need to resupply it and so on. So we won't be earning anything for the users. So we won't be yield bearing at this point of time. But if you look historically, 75% of the time funding rate was positive. So it was above zero, and only like 27% of the time it was negative. So essentially, even if we go into the bear market, I don't believe that funding rates will stay below zero for a long period of time. And obviously, for that period of time, we could, opt out of the delta neutrality and basically put maybe keep the collateral in something else that would generate yield. For example, we have some ideas on the BTC lending, right? So we could blend BTC in a secure way and earn higher APR compared to funding rates and a more stable APR to our users and offer it as a yield. And on top of that, there are also new technologies, new markets in crypto like Boros or raw trading that offers funding rate markets. So they allow you to hedge your funding rate exposure. So we will be able to hedge it. So I think we were super prepared for it, and we will have this product offered to the users as well. So users can cap the rates with Aegis through funding rate markets like raw trading and Boros. So this is also, I think, a breakthrough in the stablecoin market, and I think we will be the first ones to offer it. I'm not sure whether like Ethena is working on it or other stablecoins that do a basis rate, but we are in the final, let's say, stages of development. So we will offer it very soon.
Ermin, you mentioned something earlier about Ethena and some of the things that could potentially go wrong that you don't necessarily like. What about for Aegis? What, in a worst case scenario, what could potentially go wrong based on your positioning?
Yeah, what could go wrong is BTC will shoot up in price 90% with a short period of time, like a couple of minutes, and we won't be able to resupply the margin and to basically exit the position. So that's the main risk. The second risk is that custodian goes down. For example, we currently work with Copper. We also have Safu, Fireblocks. We will diversify into other custodians as well. But essentially, that's the second risk, that custodian goes down. And basically, we cannot perform trades. Our funds are locked and we cannot repay the users. But even for that, we have a protection. So Copper is a trust based in Switzerland. So according to their structure, our users or we as a client, we would still be able to access those funds because they are segregated from the other clients' funds. We will be able to access it even if the Copper goes down through a bankruptcy procedure. Obviously, it will take some time to get it back, but we will get it back. So because it's segregated, so it's not affected. Copper cannot go and take those assets and spend them, right? So due to their structure, it's not possible, and they are past regular reviews and audits from the regulator. So I'm pretty sure that it's super safe environment. And even a recent hack of Bybit showed that Copper and clear loop technology is super safe and secure because none of the funds of the users that were trading on Bybit weren't lost due to the hack because everything is segregated, nothing is moved to the exchange and so on. So yeah, but the risk of Copper going down is there because it will lock the funds for some time. So we will not have instant liquidity. So these are the two major things I think that we have in terms of risk.
To your first point, would you say that because there's that risk that BTC will shoot up, is your product better suited for like bear markets?
Uh, yeah, I think our product is better suited for the bear markets because we don't care whether the Bitcoin goes up or down. So for us, in order to make money, we need funding rates to be positive. Um, or with the new product that will launch, we can hedge it and so on. So we are super protected on that front. So yeah, we are better suited for, let's say, either stagnating markets or bear markets. But when the markets grow, we also grow because the funding rates shoot up. Because, for example, on average, we can earn 10% when the funding rates are high, and when the market is super bullish, we can earn up to 40, 60% APY. So it also affects us. So I'd say if you compare, for example, us and altcoins or BTC, right? When everything rises, everybody pile into altcoins and BTC because the returns are much higher than anything else. And the best strategy in the crypto was for the past 5, 6, 7 years is that you just buy BTC and hold it. That's it. The best strategy, the best return. So whatever else you did in crypto didn't have that kind of return, right? And but still, when the markets rise, we rise as well because the funding rates go up. But if the market goes down, everybody starts to find kind of like a place where to protect the yield and the capital, not to lose money, for example, on alt or whatever. We're well suited product for that. That's for sure.
And what is the current APR right now that you're offering?
So currently it's around 7%, but for the last 3 weeks it was around 16%. So super high, but that's a weekly return, right? If you look on average from the beginning of the year, it's 6%. So it's very volatile from week to week. But on average, I think at the end of the year, users will see around 10%. So if you held it for the whole year, it would be around 10%.
And does that percentage vary based on the funding rates or what usually plays into that variation?
Yeah, it's purely funding rate. So funding rate volatility affects this. But once we introduce this new product that I described, like raw trading and Boris, we will have it. It will be more stable because we'll be able to hedge it. Essentially, users will be able to hedge it. We cannot do that on behalf of users. We are not kind of like because our narrative, we stay delta neutral. That's our core strategy. But the users want to opt in to hedge, they can do it through us. So it will be a good option for the users that want to have more predictable rates.
What are some of the other products that you're thinking about, envisioning, or maybe you already have coming down the pike here within the next, I don't know, 6 months to a year?
Yeah, I think the main product that we are working right now on, apart from this hedging instrument, is BTC file lending. So we will basically take the collateral from the users, lock it for some period, like 3, 6, 9 months, or 12 months, and lend it through some trusted partners and in a very safe environment. And on that, we could earn significantly more compared to the funding rate. And also more stable yield, right? Because, for example, funding rate is very volatile. On lending, the rates are, let's say, in a fixed range. So you already know how much you will earn from it. Obviously, there are some additional risk involved into this in this new product, but again, we want to enable users every possible strategy that we can deliver and that we think is super safe for the users, right? So users can opt into that lending as well, and which is also will be in the form of stablecoins. So basically, like borrow USD and supply BTC. And on top of that, we will continue to get integrations into different money markets. We have Gearbox coming up. We have Morpho coming up, Lista DAO. So basically, money markets, lending markets where users can utilize the existing stablecoin, YUSD, and the staked version SYUSD as a collateral and borrow and leverage or put it into Pendle and fix the rates. So yeah, different things you can do with it. But I would say BTC Fi product is what we are focusing on right now.
What is something that, let's say, will transpire in 5 years that will catch us off guard in the stablecoin market?
Yeah, yeah, that's a good note. Yeah, I think personally, I think that a lot of projects will go down, so they will just not survive because I don't think that all the projects have the funds and also that their strategies are sustainable long term, especially in the bear market, because I still think that bear market will come. So there is no question about that. And that will uh, basically allow some 3 to 5 major projects in the space concentrate the liquidity and basically become the leaders in the space. So I don't think that we'll have a lot of like hundreds of projects having some small liquidity. We'll have like 3 to 5 major projects holding most of the liquidity, and basically the yields will come down because the more strategies become overcrowded, the less yield you can get out of it. But it will become the yield bearing stablecoins will become, let's say, a benchmark for crypto yield, a risk-free crypto yield, the same as you have in treasuries in TradFi, right? So the treasuries are usually used as a benchmark of a risk-free rate. The same will be for yield-bearing stablecoins in crypto, maybe for delta neutral ones, right? But yeah, I think the stablecoins will still dominate the market. It will be the main use case for crypto, but again, I don't think that there will be hundreds of players, just a couple of them concentrating the liquidity.
There's obviously a lot of risk involved in this, but it's really exciting to see just the evolution of stablecoins and this convergence of TradFi coming in and working with crypto. So it's been exciting. Really enjoyed having you on. Where can people learn more about Aegis and maybe connect with you?
Yeah, we have everything on our website, aegis.im. And also we have our X account. You can find all of the links there. So yeah.
Perfect. I'll be sure to include all of those links in the description. And for those that are watching, if you found this video informative, give it a like, subscribe to the channel, and head on over to networkspotlight.io and apply to become a member. Thanks, Ramin.
Yeah, thank you.
If you're a founder or operator in Web3 and want to connect with others like you, head on over to networkspotlight.io and apply to become a member. See you on the inside.